If somebody is quite heavily invested in real estate and they follow the market like you do, how much of your position or how much of your investable assets are in cash at any time?
Well, what I try and do is look at leverage on any asset based on the asset type.
What advice would you give somebody, let's say, if the market turned?
Well, first off, look for bubbles and sometimes you can't anticipate them. The second thing to do is watch flat spots. You need to look at the prospect of a recession in advance. You got to look through history and say what's happened in the past because it could happen again.
If you were just starting out in real estate today and you only had a few $100,000 to invest, what type of investment would you see?
A rent house or a duplex is the place to start and, learn the business. But the first thing you have to do is analyze yourself. If the notion of unplugging a toilet or standing on the doorstep to collect rent or going to court to perfect an eviction revolts you, don't get in the real estate business.
What is your thesis on residential real estate prices at the moment?
One of the absolute basic facts you'll look for in any real estate transaction is replacement cost. So in any market, you got to figure out what it costs somebody to build new. I don't think replacement cost is going to come down anytime soon. The mercantilism is setting in, which means we won't have the value of free trade. We won't be getting cheap stuff from China. The labor force is shrinking, which means that wages are not going to go down. So I don't see that replacement costs are coming down, which means I don't think residential real estate prices are coming down. They certainly are not accelerating as fast as they were, but I don't see them declining.
This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice.
Welcome back to the Money Seed Podcast. My guest today is Louis Belmonte. Louis is going to share with us over 5 decades of real estate experience. Louis, welcome to the show.
Thanks very much. Very happy to be here.
Louis, just before we got started, you mentioned that you have experience in just about every type of real estate investment possible. Maybe give us a quick rundown of the list again, because it's quite impressive.
Well, I've done a house flip. I've done small multifamily rehab, own low-income housing. I own a working-class housing. I've worked for 35 years building industrial buildings all over the world. I currently have a partner, and he and I have neighborhood retail in Oregon. Everything I've worked on, with the exception of a high-rise office, I've managed some, but I've never built any. Regional malls and resort property. Other than that, every form of real estate known to man.
A lot of people just start a business or invest in stocks why did you invest in real estate? What drew you to real estate?
Well, because I'm a peasant at heart, essentially, and it's something I understood. My folks divorced when I was very young, and when I was 16, I went to live with my father, and he worked for the government because the Depression had scarred him to the point that getting a government job was something he hung on to for the rest of his life. But he had all kinds of side businesses, running cattle on leased land, raising turkeys and chickens, raising walnuts, and rent houses and duplexes. And so when I went to live with him when I was 16, I became an unpaid farmhand, maintenance person, and tax preparer. So I had a little background in real estate. And the first time I tried to invest money in the stock market, I got my ass kicked, and I thought, well, let's go to something you know. So when I started in the business, I actually ended up in a little rehab deal accidentally with a guy I was rooming with after I got out of Vietnam. And I helped him finish a deal, and he and I did a couple of deals together. And then when I got married and needed a regular income, I ended up working for a developer of warehouse buildings based in New York. And I continued doing for that employer who went broke, and then 2 after that, building warehouses, and ended up building them in all the major cities in the United States, in Mexico, in Tokyo, in Singapore. I know more about warehouses than most any human being on earth. It's not that complicated. 4 walls and a roof 4 feet off the ground, but I know a whole lot about that very simple field. I've also managed and leased lots of retail, office. My partner and I currently own a lot of low-income housing, a field unto itself. So I've had a plethora of different experience in different types of real estate. I also was a junior partner in the founding of what is now the world's largest REIT, Prologis, and so I know something about REIT investment as a result of that, because I am a stockholder in that company and follow it like a hawk. And so, when I got to go through the whole IPO process, so I'm pretty good with REIT stock too.
I imagine that you lived through some of the ups and downs of the business. I know that we had, whether it's high inflation in the 1970s or economic turndowns, maybe 5 or 6 recessions, and of course the 2000.
Well, a total of 7 recessions, and I got better at them as time went on. And I actually think that recessions are the most important part of real estate investment. And my former boss, president, or the CEO and board chair of Prologis, had a little motto: big money in real estate is made by those who have cash when nobody else does. So I've always tried to end up in a good cash position when entering a recession, because that's when the deals are made.
Cash positions. If somebody is quite heavily invested in real estate and they follow the market like you do, how much of your position or how much of your investable assets are in cash at any time?
Well, what I try and do is look at leverage on any asset based on the asset type. So if I own a suburban office building at a remote freeway interchange in Texas, I better have no debt at all. If I own an apartment building in a dense market, then I can get money from HUD or Fannie or Freddie, maybe a 75 or 80% loan is appropriate. In general, on our retail assets, I try and restrict the leverage to 50% of value, and that's 50% of value conservatively calculated. So at reasonable cap rates, and I also try and figure out how bad things could get in a real recession, how much rents are going to fall, how much vacancy's got to go up based on the history of that product type and that market, and make sure that we can cover debt service in that event. In places where our tenants might be shaky, we try and reserve 6 months debt service plus 6 months maintenance. In places where we have really shaky tenants, our reserves are up to a year's debt service. So we try and stay as liquid as possible, because stuff always goes wrong.
I think the last time we had a major recession was maybe in 2008, 2009. So it's been 10, 15 years now, and maybe a lot of investors don't really have that experience of going through it. But what advice would you give somebody, let's say, if the market turned?
Well, first off, look for bubbles. And sometimes you can't anticipate them. The office market right now is in the toilet. The vacancy in San Francisco office space is worse than it's ever been ever. Buildings are selling for 20 cents on the dollar of replacement cost. It's hard to figure out how bad that can be. The second thing to do is watch flat spots. If you're in Atlanta, Denver, Dallas, Houston, where you can get on a ladder and see 2 states away, and where it's easy to get a building permit, things can go to hell in a hurry. So you have to be prepared to look at really down markets and either buy in when it's low and sell when it's close to high, or be prepared to ride out the cycle. So you got to look at what the bad case scenario is and have as many outs as possible. So if you've got a multi-tenant building, maybe you can subdivide it so you can sell part of it off in a pinch, or get some extensions on your financing. So a lot of people are going to have a huge problem with loan rollover. And they had an opportunity a few years ago when money was on sale to fix for 10 or 15 years. And instead they went variable or went shorter because they could save a few basis points. My partner and I, because I have scars all over my body, fixed everything we could fix 3 years ago, 10 and 15 years out. And our biggest loan is with HUD, 35 years, and I ain't going to live long enough to pay that one off. You need to look at the prospect of a recession in advance, and you need to read a little history. So I sold a deal in the early 80s and had some cash on hand and invested it in treasury bills at 11 and a quarter. Thank you. And at about the same time, my father-in-law died and I sold the family home, and on behalf of the widow, invested the proceeds in a AA bond fund at 16 and a half. So everybody kind of forgets that went on, and they think this little inflationary twitch we've had is new and different. It's not new and different. We've been there before. So you got to look through history and say what's happened in the past, because it could happen again. Bubbles build up. When we were doing liar loans and no credit, no job, no nothing loans, you got to say to yourself, something's going crazy here. And, I own some units in the East Bay in San Francisco, and I'm driving down the road listening to country music on the radio, and some guy comes on and offers to give me 125% of the value of my house in the form of a second mortgage. I say to myself, the world's gone crazy. And I looked up the hill at the units I own, and I thought, those suckers have never really made me any money. And so I thought, I'm just going to sell them all, because the bubble is incredible. And in fact, I got almost 2x what they were worth a few years later, just because I could see the froth in front of my eyes. And one of the deals, I sold a 4-unit building to a mother and daughter combination, $800,000. They put not one penny in the deal, and they were going to live in and have an $800,000 loan on 4 units. I didn't expect them to last 2 months, but I took the money out of escrow and left. Never looked back. It's insanity. And I read a piece at that time that in Naples, Florida, 50% of every house selling was sold to a speculator. And you got to say to yourself, this doesn't look good. This is coming to an end. And you got to look for secular trends. As soon as Amazon came along and had online retail, you had to say to yourself, well, this is going to hurt retail real estate. And in fact, we're going to go from 3,200 regional malls to 800 before it's over. And you could have seen it coming if you looked at the way Amazon sales and online sales in general were growing, and saying that, the world of retail real estate has changed, and we're going to have a hard time here for a few years.
And so right now, Louis, would you say that the Bay Area itself, or the Bay Area specifically, is in a bubble when it comes to real estate?
Well, right now, the office vacancy in San Francisco is 40%, worse than it's ever been. And the retail vacancy in San Francisco is worse than it's ever been. In the case of the office, it's because we had so much tech business, and that's the stuff where remote work is most appropriate. So that's just nobody's fault. In the case of retail, we've done everything possible to discourage retail in this town, and so it's all about public policy. In general, the Bay Area is going to come back because it's still going to be a tech capital, because tech people have to gather with each other, otherwise they become obsolete overnight. So right now we got AI people flocking in here. It doesn't take up that much space, but this is one of the 2 or 3 hubs on Earth for AI. This is one of the 4 or 5 hubs on Earth for biotech. And so those things are going to continue to prosper. And when VC money comes in, and right now, about 50% of all VC money raised is invested somewhere in California, and most of it in the Bay Area. And that isn't going to go away. So in the due course, we'll come back. But it's going to be a little bloody in the office sector for a while, and in the biotech sector, because that's overbuilt too. And the dynamic of supply and demand is always what it's about. So the things that kill you are excess supply, diminution of demand, and the flight of capital markets. So if you got an office building now, you couldn't get a loan to save your ass. So, and that's a real, if your loan is rolling over, just shoot yourself. It's going to be very tough to roll that loan over. So those are the things that go wrong.
Tell me more about Seven Hills Properties. I believe you're a founding partner and you own commercial properties all along the West Coast through Seven Hills. Tell me about more, what types of properties does Seven Hills invest in, and what kind of clients do you invest on behalf of?
So when I first went to work for the predecessor of Prologis, they were advisors to pension funds and university endowments, and they hired me to be their pet developer. So I was going to go out and do deals in the 90s. and they were going to cover my overhead. We were going to split the profit. I had worked for a developer who did tax syndications, which came to an end in 1986, and they were de facto broke. And so, I moved to the other side of the equation where the money was. And what happened over time is there weren't many development deals the guys were interested in. They were much more conservative than I was. So I ended up being their troubleshooter. But I had a little development company that I ran as part of the deal, and I had a street partner. And so in 2004, I was 64 years old, and I was running, we had by then gone public, and I was running the development program for the company, and we were opening up in Asia, and the boss said, we want to take this from several $100 million a year to several billion. We think you're too old to do it. And I said, I'm too old to fly to Japan and Singapore on a regular basis, so I'm not going to fight you on this. And they gave me a very nice parting package. And so I took the little business that I'd been running and moved it off, and my street partner and I set up Seven Hills. And we are actually developers. There's hardly anybody left that's truly a commercial developer anymore. What they do is work for, as indentured servants, work for the money. We actually put our own equity in deals, and we have almost no outside partners. And the way we were able to do that is we did a lot of merchant building. We built 30 drugstores for Walgreens. And so we had deals with Walgreens. We'd build the building. As soon as the slab was dry, we'd sell it to a 1031 buyer who was tired of running apartments. And we'd take the profit and either pay off the remainder of the land on the site or build our balance sheet with it. So we created investment capital so we can do our own stuff. And then we did a couple of big low-income deals, which are absolute brain damage, but your investment is very little and your risk is very little, and you have to wait a while to be truly profitable. But both of those deals are now seasoned, and we make good cash flow from them. So, and our retail's full, and it's flowing cash. We had one little bleeder deal that we finally got the last of at least. So we're now living on cash flow and coasting.
That's amazing. If someone were just starting out in real estate today, or let's say if you were just starting out in real estate today and you only had a few $100,000 to invest, what type of investment would you see?
A rent house or a duplex is the place to start and, learn the business. But the first thing you have to do is analyze yourself. If the notion of unplugging a toilet or standing on the doorstep to collect rent or going to court to perfect an eviction revolts you, don't get in the real estate business. And you're going to learn a little at a time, but it's the mud and the blood and the beer out there. So, and you got to remember, when you're renting things in the residential sector, economically speaking, the top 2/3 of the society lives in a single family dwelling they own, and the bottom 1/3 is in a rental of some kind. So you're going to deal with the shallow end of life's gene pool. If you're not prepared to that, do not get in the business. If you're not prepared to chase deadbeats, if you're not prepared to be threatened, if you're going to do any kind of development business, be prepared to be hated. If you watch mysteries on TV or streaming, if there's a developer in the cast, that's the murderer. So, I've stood in front of planning commissions and city councils and boards of supervisors and been pilloried and called a mother raper and a father raper over and over again. I don't care, because I'm a developer. That's the kind of guy I am. I don't care what you think of me. I'm always prepared to trade dignity for dollars. And so you need to figure out what your personality is all about. And I recommend to everybody they take aptitude tests. If you're a sociopath like I am, you can be a developer. If you're high ambition, a high socialization, high empathy, then you can be a salesperson. If you have a high sense of responsibility like a nurse or a social worker, you can be a property manager. If you're analytical, then you should be an investor, not an operator. And you can find an operator to partner with, but don't do it yourself, because you're not out there with the hands-on. If you're reasonably handy, reasonably ambitious, and don't mind wallowing around in the mud, then go buy yourself a rent house or a duplex, put up as much cash as you can afford, get in upgrade it a little bit, shine it up, put some lipstick on the pig, sell it, go do the next one. So I started out buying 2 and 3 unit buildings in San Francisco, and I found a broker who would guarantee the first, induce the sellers when there was no money to be had in that sector to carry a 15% second. I'd put up my 10% down, get in and work nights and weekends, clean it up, raise the rents, get some cash flow, accumulate another 10%, go buy the next one. So, just elbow grease and a little cash.
How do you see the future of real estate today? Is it any different than it was decades ago, or do you think the market has changed in some fundamental way?
Well, the market changed with the invention of the personal computer, which allowed us to do IRRs and sensitivity analysis. I focused on spendable, how much money ended up in my hand at the end of the month, and was it enough that I could accumulate the down payment for the next deal 2 years from now? We weren't doing IRRs and sensitivity analysis. So there's a whole lot of money out there that's being invested by people who are writing checks with other people's money. You got to stay as far away from them as possible. And the business is now in the hands of private equity and institutional capital. And so you got to stay under that radar. And one of the reasons my partner and I do small deals is because the big dogs don't want to fiddle around with $4 and $5 million deals. So so that from that perspective, it absolutely has changed. But there is a lot more money available to the small entrepreneur than there used to be. When I was first in the business, we had a lot of seller carryback. We had a lot of wraparounds because nobody put any money in small-time real estate. And private individuals carried seconds. There were a few, little subculture of people who did seconds. Right now, there's home equity loans, and there's people that'll even lend you money to be a house flipper. So there's more money available to the small entrepreneur than there used to be. And in the big leagues, it's all big time money and it's all fee based. So, when you're dealing with a lot of deals, you'll find that the people writing the check are charging fees to the people who actually invested the money and are not doing it themselves.
And we've spoken about the high, residential real estate prices in the San Francisco Bay Area, but in general across America right now, residential real estate is quite expensive. Some say it's at a premium. Do you see that coming down in the future, or what is your thesis on residential real estate prices at the moment?
One of the absolute basic facts you'll look for in any real estate transaction is replacement cost. So in any market, you got to figure out what it costs somebody to build new. And if you're going to buy something, you better be buying it below that cost, because otherwise the next new deal is going to kick your ass. And when you're looking at replacement costs, let's say that you determine that replacement cost for this asset is $100,000 and you're buying an asset for $80,000. And this is a big confusion on the institutional side. I guarantee you, in glass-walled conference rooms high above Wall Street, they're making this mistake. You say, well, I'm buying 20% below replacement cost. You are not, because your building isn't new. So you got to take the $80,000 and say, how much would it cost me to turn this into like new? And if that cost exceeds $20,000, you haven't bought below replacement cost. And very few people are making that analysis. The other way to look at it is to say, okay, this is what the new structure would rent for. This is what a used structure rents for. What's the capitalized value of the delta? Add that to your price and see if you're really buying below replacement cost. If you are, it's pretty hard to go wrong. I don't think replacement cost is going to come down anytime soon. The mercantilism is setting in, which means we won't have the value of free trade. We won't be getting cheap stuff from China. The labor force is shrinking, which means that wages are not going to go down. So I don't see that replacement costs are coming down, which means I don't think residential real estate prices are coming down. They certainly are not accelerating as fast as they were, but I don't see them declining. Now, that doesn't mean you can't go to Denver and buy an apartment building at today's number and not get your ass kicked 4 years from now, when there's a whole lot of new stuff coming out of the ground and everybody has to give away the store to get full. So you got to watch yourself in flat spots. But as long as there is a geography that constrains the building then you're probably pretty safe. In San Francisco, we have both geographic constraints and political constraints. Interestingly enough, the political constraints tend to come down when times are tough. So it's brain damage to build when times are good. It's kind of 3/4 brain damage to build when they really need fees.
And Louis, as we move toward wrapping up, I'm really curious. Tell me about your first real estate deal and your best real estate deal.
My first real estate deal was a duplex in Corning, California that I inherited from my father that I needed to sell because I was going in the Navy. And I sold it to a local broker, actually a woman, a very unusual thing in 1964, for $7,000, $700,000 down, and I carried the paper. That was my first real estate deal. My best real estate deal was a total accident. A guy walked into my office from American Express when I worked in Foster City and said he wanted me to build an office building cum traveler's check vault. And he had to build 22 of these around the world. And he said, this looks like a good place on the map to put this thing. And I said, well, you don't want to do that in Foster City because we're on bay mud and the vault will sink into the bay. But I got another piece of dirt in San Bruno I can show you. Let's drive up there. And he looked at it and he said, this will do. Send me a quote. And I tried to figure, and the vault was 18 inches thick with 6 layers of rebar on 6 sides, plus his office space. I could not figure out how to bid it. So I finally just wrote him a letter and said, I have no idea how to bid this. What are you prepared to pay? Said, I won't pay $1 over $7 net. And I said, fine, my quote's $698. And I proceeded to build the thing. And then we built a little industrial park around it. And just at that time, the competing market got 100% leased. The freeway right next to us got completed. The place filled up in a nanosecond at above my pro forma. And some syndicator came along with a bunch of tax-oriented investors and offered us a price that was humongously outrageous, and we took it, and everybody sliced a fat hog, and it was a total damn accident from start to finish.
It's a great story. I think everyone is hoping for one of those outcomes in real estate,
well,
and I congratulate you on your success.
I have stories on the other side, should you wish to know, the ones that I avert my eyes from as I drive around. So, but that was the slice the fat hog deal.
Yeah, and look, it's always easier to talk about, some of the successes and home runs we've hit. No one likes to brag about some of the deals that go south, and everyone's got a few of those.
Well, if you want to read about some of mine, buy some of my books on Amazon. I talk about mistakes. That's the pitch of everything I write is this is what went wrong, or this is what went sideways, or this is what was screwy, and this is what I think I learned.
Yeah, I was going to ask you about your books, and thanks for bringing that up. I think one's called Real Estate 101. The other one's called Street Dog MBA. Which book, what are the books about, and what can people learn from them?
Well, Real Estate 101 is kind of a survey. So I start out by saying, the only real estate investment you might ever make is to buy a house. And here's the things you need to do. You need to find the right broker who specializes in the neighborhood where you're buying and listen to what they have to say. You got to analyze the comparables, go put your hands on the comparables. You got to get a structural inspection. You got to figure out what the local zoning is, and don't go into this thing without expert help because, speaking, you're making a huge investment, and trying to save a few bucks on a commission is the stupidest thing you could do. Then I talk about various kinds of real estate, apartments, retail, industrial, office, and what the key elements of each of those kinds of real estate are, what institutional real estate is all about, what REITs are all about. Just a survey of the business for someone who's just thinking about getting into it. Street Dog MBA is basically stories about things that have happened to me and lessons that I've learned as a result of those stories, some of which are total screw-ups, some of which are just accidents, but this is the story of what happened, and this is what I learned from it, and this is the general principle you can take out of this experience, one of which is one of the things I learned early on is when I'm looking to buy something, I calculate to myself how many hours of work it takes to afford that thing and decide whether it's worth it. And that takes me into figuring out risk reward. So when you're looking at a deal, what's the rate of return you're going to receive, and how much work are you going to have to put in to get it, and how much risk are you taking? If the deal is perfect, maybe a 5% return is acceptable. If the deal is brain damaged, maybe you need a 20% return. But you got to pick the right gauge. And so you don't want to be doing a 20% risk deal at a 5% return. It's all about risk reward in any transaction and properly underwriting that. So that kind of thing. Then I've got a book called Street Dog Negotiator, and that's about the attitude of indifference. The strongest thing you can have in any negotiation is not giving a rat's ass whether you make the deal or not. So you walk into the room, no matter how sophisticated and how many $1,000 an hour lawyers, and you have a list of what you need to get out of the deal and what you'd like to get out of the deal. And if you could get what you need and a little of what you like, put a fork in it, congratulate everybody, tell them what a great job they did beating your brains out, get out of the room. And if you can't get what you need, just get up and leave. Just don't worry about it. And if I go in not caring whether I make the deal or not, then I'm able to do that. And that attitude is right out ahead of me. So if I go in and I really need the deal and I'm scared and, oh God, we got to do this deal, I've had it. I'm going to get slaughtered. And try and organize your life to be indifferent to the outcome of every transaction. If I'm buying, I got a price I'm prepared to pay. If that's not the price you want, why bother talking? If I'm selling, I got a price that I think is fair. If your price is 3% less than that, maybe we can talk. If it's 10% less than that, I'm sorry, there's nothing here to discuss. 88 and out the gate. And then I've just published a book called Street Dog Manager, and my push there is humility. If you're running an organization, you're not the boss, you're the servant. You're not there for power and compensation. You're there to serve the organization, and the power and compensation follow. So first, you got to be humble and teachable and a motivator. And if you do all of those things, then you have a success, then you make some money, then you're a poobah. But don't start out being a poobah and think that people are going to do what you want them to, because they're going to do what they want to do. And I'm working on Street Dog Investor, which is basically, pay off your credit card debt, put a little money aside, decide what you're good at, and invest a little something, because when you get to be as old as I am, you're going to need the money.
That's exactly what we tell our listeners all the time. But yeah, getting back to the negotiation part of it, I think that is such good advice, is to not be emotionally invested and always have the ability to just walk away, right? I think that is fantastic
always
advice.
Never think about win or win-win. Always tell the other team they won. Because even if I can win and act like it, I piss somebody off.
Louis, I love your story, and thank you very much for sharing it with us today. I will put the links to the books into the show notes. Where can people reach out to you if they want to learn more?
Belmonte at 7hp.com.
Sounds good. I'll put that into the show notes as well. Louis, thanks very much for taking the time today. It was a pleasure speaking with you.
It was a pleasure to speak to you. I wish you the very best. And if you have any questions about a deal, I will try and answer them.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.